So will you carry on the recording then, or?
Yeah, of course, I will
Okay.
carry on with the recording so far. Maybe we are even faster. Yeah,
Okay.
that's the maximum because I scheduled always 2.5 hours as a reserve because if there are more students, then we can have also a decent discussion. Therefore, yeah,
I
that's
understand.
the intention. Yeah,
Yeah.
that's the intention here behind. Yeah, let me just go here to the overview. So you see here 14 topics we will cover. Yeah, and we do it on weekly basis. Before we start, I would also like to introduce myself just briefly so that you know. Yeah, my name is Ed. As you can hear, I'm not a natural born Malaysian, so I come originally from Europe, but meanwhile already some 5 years here in Malaysia, and also quite integrated here in Malaysia in terms of being member of Malaysian Institutes of Accountants, CPA Australia, the Institute of Corporate Directors, and so on. Also MAICSA, and working experience so far with international and domestic SMEs and MNCs. And I have also here some lecturing assignments and do some guest speaking. The academic background so far is I have an MBA in finance. Then I have another MBA in social science and various certificates such as enterprise risk manager, certified corporate treasury manager, certified M&A manager, certified IFRS accountant. So I think from the background, you are in good hands so far. Yeah. But please feel free to interrupt me at any time when you have questions so that we can then discuss your approach and your questions accordingly. So what are the topics? Yeah, the topics are exactly organized according to the syllabus of CGI UK and also MAICSA. So there you will find 14 topics covering the entire program so far. So how I will deliver the bootcamp? Yeah, it's a live Q&A session, and therefore I have also prepared some risk dashboards. Yeah, that will help here that we can dive here then in a very concise way into it, and also to round up or to have a wrap up. I deliver then after the class also a short podcast. Yeah, that's just 10 minutes so that we have here the most important things summarized. Yeah, you see here it's the delivery. We have the discussion. Yeah, we do the Q&As. We look into the dashboard. Yeah, we listen to the podcast. Yeah, and of course, if we need, because let me say, if we conduct the class over 2.5 hours, maybe we need some break as well. Then just let me know when we start or when you want to have here the break so far. Yeah, let me immediately dive into the questions. Yeah, I have also uploaded the questions in the Google Drive, so you can download there. You can see here. The questions are organized according to the chapters, and the intention is also that you will get from now onwards always the question ahead of our bootcamp. So maybe you find some time during the week to dive into the question and have come up already with some ideas how you would answer the question accordingly. Then we can also discuss precisely your approach of answer. Yeah, then I can also give you some feedback here too. So therefore, you find two documents. One document is just that we have here the 25 most salient questions. Yeah, these are, let me say, potential questions which or how they can come up here in exam as well. And of course, here too, yeah, the suggested answers as well. Yeah, and the suggested answers, as advertised, we will always do in that way, that we have the answer in a bullet format, so very short and concise. And we have also the narrative answer to it, yeah, and that's here quite helpful. And the dashboard looks here in the way. Give me a second, then I show you the dashboard as well. Yeah. The dashboard is an HTML document. Yeah, that I have already also uploaded. Yeah, you can here even dive through. It's a bit animated. Yeah, and also very concise, so that that we go through 2 times. Yeah, and then the knowledge is already anchored, and you need not to put that much effort in learning anymore. Yeah, because if you repeat things 2-3 times, then you can learn it already accordingly. Yeah, what's the overview? The first module is about the global risk environment. Yeah, here it's about that we look here into the core concept. Yeah, what are the 3 groups of the global risk environment? Yeah, that we have here the diving into the shareholder, yeah, into the stakeholder approach. Yeah. Who is interested here in this global risk environment, who is part of the environment itself. We will also hear then who are the regulatory agencies, yeah, for example, the Financial Stability Board, yeah, the IMF, yeah, the Bank of International Settlement, OECD. These are some regulatory agency. Also, when you think about Malaysia, yeah, it's Bursa Malaysia listing requirements which might affect here the risk environment. Yeah, it's also about the Malaysian Code of Corporate Governance, yeah, and then legal frameworks such as the Malaysian Financial Reporting System, MBERS, yeah, and things like that are here relevant. So, who are the standard setting bodies? Yeah, that's also important here to know. Yeah, this bootcamp is here oriented based on ISO 31000 as well as on the elements of COSO ERM. Yeah, ISO is, let me say, the international standards organization, more or less a bit European dominated, whereas COSO ERM is US dominated. Yeah? And as a third setting body, we have also this Basel Committee. Yeah, the Basel Committee is, as the name says, Basel is a town in Switzerland, and it's foremost here risk management, dedicated or assigned specifically for the banks. Yeah, and here we have already Basel 3, yeah, and now Basel 4 is in involvement, and that is precisely regulating, for example, capital adequacy for banks, yeah, just to name here. Or they use also this Camel framework, yeah, where they steer here the banks according to their risk management. Yeah. Yeah, then of course it's about risk. Yeah, risk is here always to understand when we think about the holistic approach. Yeah, in terms of enterprise risk management system, then of course there is a high integration between the strategic approach and the operational approach. Yeah. And therefore, it is rolled out throughout the entire organization or the entire entity, the entire company so far. Yeah. Risk as input and output. Of course, we have here existing risk. We have also emerging risks. Yeah, and every decision made in a business environment, of course, has to deal with evaluation of risk, and ultimately also with mitigation of risk, with risk reporting, and so on. And therefore, it is here important that you have a strategic approach, where you already embed risk management here in your strategy. For example, whenever you want to realize your vision, your mission, and so on, then you define strategic objectives. Let me say in 5 years you want exactly to conquer this and that market. Then of course you need a feasibility study whether this is really makes sense to do. Where are the opportunities? And where are the risks? That's here what the strategic decision is here also about. And that helps here with the implementation or with the setting up of the risk register, and ultimately also the principle, defining the principal risks. The principal risk, these are the most important risk a company is exposed to. And that's ultimately also what the company, a stock listed company, also here in Malaysia, is reporting about. That's the principal risk. So that's here. And then in terms of stakeholder risk tolerance, usually also part of the reporting is the so-called risk appetite statement. And here risk appetite statement, that is highly dependent on the level how let me say the stakeholder or the individuals are whether they are risk seeking, whether they are risk neutral, or whether they are risk adverse. And therefore you see here that's ultimately also defining here the risk tolerance. An employee, for example, is much much more lesser here in accepting risks than, for example, the shareholder itself. The creditors, for example, banks, they are also very limited here when it comes to risk tolerance. And they have then precise thresholds, and that's the maximum. And you need always to understand that you start always from the inherent risks. So what is inherent risk? That is about that we have here the gross risk, and then you do mitigation, and ultimately the risk tolerance is aligned with your risk appetite and is reflecting then the net risk, the residual risk. That's here for your understanding. Then why shareholders may not be risk adverse. Usually we have here the terminology of asymmetric returns. So asymmetric returns means that there might be a higher risk. Then let me say the upside potential is higher than the downside. Then of course you say, okay, it makes sense to take this risk because the return profile is more positive than ultimately what can I face as a loss. Then of course it makes sense. If it is the other way around, then it's high questionable. It cannot be that the downside risk, that the loss potential is higher than the return potential. That would not make sense. Then you would exclude this opportunity upfront already. Limited liability, that's here when you think about the company, the entity, the forms of entity, then usually it's always about that a shareholder wants just to take a limited liability. That's the maximum loss that they are ultimately prepared to take. And if you think about the shareholder, the first capital pay-in, that would be the cap of their liability. And if there is nothing more mentioned in the memorandum or in the articles of association, that in case of loss they have to contribute, the shareholder have to contribute additional capital, then the initial capital, that's it. And that's here the limit of their liability. When you think about risk, dealing with risk, then it's always one one guideline or elementary guideline is that you should always take care of diversification. Yeah, here just don't put all your eggs in one basket. Yeah, that's the best way. Whenever you have more opportunities available, yeah, and you have enough money to invest, yeah, then don't just invest in one opportunity. Try to achieve your objective with two or more opportunities. For example, yeah, when you want to conquer a new market, yeah, then you engage a sales agent. You set up a joint venture, maybe with a partner. Yeah, you look for a brownfield investment. Yeah, that's for example the ways how you can mitigate, because one of these three opportunities will work, yeah, even if another would fail. Yeah, and then you are still able here to keep on track. Yeah. When you have when you look into the types of regulations, then of course we have here two main differentiation. That's the rule-based approach and the principle-based approach. Yeah? Rule-based approach is more, let me say, US dominated, whereas the principle approach, ISO, yeah, the European approach is more principle approach. Yeah? Principle approach gives you a wider, yeah, more flexibility. That we will see then based on exam questions later on. We will discuss this in yeah, great detail so far. Yeah. Yeah, then the Basel Accords, here you see Basel 1 started already in 1998. Yeah, Basel 2 was then updated in terms of risk sensitivity approach in 2004. And now, right now, we have the regime Basel 3 in place. Yeah, and since 2019, they are already updating. Yeah, you see here this Basel 3 is, of course, heavily influenced by the financial crisis, which has happened in 2007, 2008. And then they defined, for example, minimum capital requirement, yeah, of a bank is 7% plus 2.5% buffer, yeah, plus extra 4.5% reserves. Yeah, just to give you here an outline. Yeah. Yeah, and when it comes to the asymmetric information, that's the efficient market theory. I think maybe you have heard about. Yeah, that's about here. Usually, the market participants, they shall have the same access to information, yeah, in the same quality at the same time. Yeah, but in reality, we know we have an asymmetric information. Not everybody has here the same access to information. Yeah, just when you think about, yeah, the company which is selling goods, of course, they know the product much better than the consumers. Yeah, the consumers just need to trust. So therefore, if there is a product defect, yeah, then this product defect might be hidden from the consumer, and that's for example, that's an asymmetric information. Yeah. Or, for example, workplace hazards are not disclosed to employees. Yeah, just that you have here an idea. And what is also here important to know in the first session, so in the first chapter, the public goods problem. Are you familiar with the public goods problem? Hello?
Hi, no, I'm not familiar with that.
You are not familiar with that.
No.
Yeah, that's in particular here that we have goods, yeah, which belongs in a way to the general public. Yeah, when you think about the air which we breathe, yeah, and the water, yeah, which we drink and so on, that doesn't really belong to a company or to a country. So therefore, it's a public good. Yeah. And if you have such a situation that you have, for example, now in chemical industry, which uses a lot of water and then releases contaminated water back into the environment, then you have here also this mismatch, yeah, that an individual polluter is here polluting the water, but is not really paying for the damage, because the damage has then to be borne by the public, and therefore this is a principal problem. Yeah. And when you think about the pollution crosses national borders. They don't stop at the border and say, "Oh, I show my passport," and then the carbon dioxide just walks in to another country. No, that's not in that way. So therefore, we have here this issue with public goods. And here, the regulation shall be updated insofar that if you have a polluter, then the polluter shall pay. Right now, this is not really the case because often the polluter cannot be traced. Is this so far understandable for you?
Hi, yes, it is understandable.
Okay, yeah, that's great. Yeah, please just feel free always to ask also the questions accordingly. Yeah, let us now look into the question itself. You see here is the dashboard. Yeah, and then of course we can look here into detail, but I would like to do this in a parallel way so that we have here, of course, maybe I can do it like this. Yeah. That we see, hopefully this I can also, adjust from the size, and then we can discuss, So let us start. The first question would be, define the global risk environment and identify 3 main groups that comprise it. So how would you approach this question? Any idea?
No, not yet. I'll just take guidance from you. Thank you.
Huh? What do you mean?
No, I'll take guidance from you. I'll just follow through with what you're mentioning right now.
Okay, so you would prefer just to listen instead here, that we try to develop the answer together.
Yes, I will jump in if I don't understand, but I think for the time.
Okay. Yeah, okay. Yeah, because from the learning perspective, when you deal with a question and when you discuss a question, then you already learn a lot. Yeah. So just passively listening, let me say that is a bit harder to absorb. When you already think about and when you discuss and you also find some points and so on, then you interact with the question already actively, and then you learn a lot because you might even remember then in exam, okay, I discussed this and this and this. Yeah, you know what I mean. Okay. Doesn't matter. So when we look here into the question, then of course the global risk environment, that is here meant in the international context. Yeah. And we have to see here the risk as a global environment. Why as a global environment? Because nowadays we do a lot of international business, a lot of export, a lot of import. So therefore here the risk regulations, the frameworks shall be harmonized. Yeah, and therefore we have to look it not only from the country perspective or from a company perspective. We have to look into a risk, from a global perspective. And here, for example, when it comes to reporting, we have this Global Reporting Initiative. GRI. That's a bit the latest development here, and is of course also influencing here risk frameworks accordingly. So it's about that we have here a more or less standardized landscape. We work on common standards. And also that here the stakeholder expectations are here reflected as well. Yeah? And therefore, when you think about what are the three main groups, yeah, then we can say, yeah, it's these are the stakeholders. Yeah, they have a high interest here in risk management. Yeah, from a different perspective. A consumer, of course, sees it differently to a creditor or to an owner or the shareholder. Yeah, these are all stakeholders. Yeah. Then the regulatory agencies is another group. Yeah, here we have the national and international bodies. Yeah, they create here the framework itself. Yeah, and when you think about right now, a lot of risk management frameworks, they are on voluntary basis. Even, let me say, when you think about the Malaysian Code of Corporate Governance, yeah, it's on mostly on voluntary basis, just for listed companies. Parts of it are mandatory to fulfill. Yeah. The same is, nobody forces you to be certified by ISO 31000, which is risk management. Yeah. That's on voluntary basis. There is just maybe in some industries a pressure to do so, that you are certified. Yeah, for example, when you think about the aviation industry, yeah, or the automotive industry or pharmaceutical industry, they, of course, they organize here their value creation chain, and all the suppliers, they need to be certified by 31000, ISO 31000. Otherwise, they won't be listed as a supplier. That's here indirectly a pressure, but nobody really forces you. If you don't want to deliver your components, to the automotive industry, then no need to do. So that you have here also this understanding that it is on voluntary basis. Then we have here the standard setting bodies. That's here the regimes itself. You can here work on ISO. You can work on COSO. These are the two main main organizations. When you think about the country regulations, the British Code of Corporate Governance or British regulations regarding to risk management, that's more or less a copy paste from ISO. So a lot of countries, they embed here ISO standards in their local standards so far. Do you have any questions at this point?
No questions at this point. Thank you for
no questions. Okay, Then you see, of course, we don't read now through all the detailed narrative text, but you have here also some texts. For example, here additionally is mentioned the financial regulator. When you think about financial risks, then of course the Financial Stability Board, that is here the predominant board setting here frameworks and standards. When you think about health and safety, of course, here the International Labour Organization for Health and Safety plays a pivotal role. You see, that's here. And the COSO, here, that's an abbreviation. COSO stands for the Committee of Sponsoring Organizations of the Treadway Commission. These are different bodies, also statutory and professional bodies. They came together to form this committee, and that committee was then building here this COSO ERM, Enterprise Risk Management framework, where a lot of American companies, they implement here risk management according to the COSO COSO framework so far. You have here also some short visualization that I do here always in table form. Insofar in table form, because I think this is also helpful that you have the necessary passwords yeah, for the exam just summarized. Yeah, then you say, okay, who are the groups? Yeah, we have the stakeholder. Who are the key members? Are shareholders, employees, and so forth. And what is their role in risk environment? Yeah, of course, the stakeholders, when you think about, they define the risk preferences. Yeah, each of them has their individual risk preference. They receive here the value from effective risk management because they are also the addressees, yeah, of the risk management. They are looking into the reports of a company. Based on the report, they decide whether they become shareholders or not. They invest in the company or not. Yeah, and of course, therefore, we need to have high standards because if there are not standards given, yeah, and not followed, then of course there would be poor practices and there would not be a protection of investors. So therefore, investors protection is here a main aim, which or main purpose which risk management is fulfilling. Yeah, you have here then the second group, the regulatory agencies. Yeah, they create and enforce the regulations. They protect here public goods as far as possible. Yeah, they say, okay, when it comes to finance, because finance, the infrastructure, yeah, the financial market itself is also regarded as a public good, so that it is functioning. Yeah, so we need to have, for example, Bursa Malaysia as the watchdog, that the financial markets are working properly. Yeah? And it's also about here, in case there are market failures, that we have responsible persons. If the stock exchange finds out, if at the stock exchange there is some insider trading ongoing, then we have the SEC. Yeah, they are looking here, the Securities Commission, in Malaysia. Yeah, they look what's going on at the stock exchange, in Kuala Lumpur so far. Yeah, that would be here the discussion of question 1. Yeah, and for you also, you can here look into, because some students, they like to have some visual effects. Yeah, and therefore this dashboard is aimed at, that you have here some coloring organized here in a nice way, and then you can also click here accordingly, so that you have here some animation. Yeah. So far, what is your impression of the delivery of this bootcamp so far?
I think it's quite insightful. You're pretty in depth about explaining how to answer the question. I did have a question when you started mentioning about what I would, and I think what might be helpful for the participants from Malaysia is that if there are some examples that relate to Malaysian entities or Malaysian agencies or bodies. So when you mentioned about SC just now,
SC, that's the Security Commission,
as well as would Bursa also be
Bursa Malaysia, Bursa Malaysia listing requirements,
Okay. Would they fall under the regulatory agencies, or are they sitting under the standard setting? I'm assuming they would be under the regulatory agencies.
Yeah, they are part. Yeah, they would also here part of the standard setting bodies. Yeah, of course. Insofar as the Securities Commission is the direct watchdog of the Bursa Malaysia. What is their instrument? Yeah, the framework itself are the listing requirements. Yeah, and you have, of course, differentiated listing requirements insofar as we have the main market and the ACE market. Yes. There are different ones. The main market is even more requiring. They here that the reporting requirements standard is higher than the ACE at the ACE. And SEC, and the framework Bursa Malaysia listing is, of course, ultimately who is the top authority when it comes to Malaysia. The top authority is so far Bank Negara. Yeah, because they are the watchdog, they are organizing the financial markets, and that the financial market is working. And when you think about the professional bodies, yeah, then you can also mention here as standard setting bodies, yeah, MAICSA, for example. MAICSA is the standard setting bodies for the company secretaries and the administrators. Yeah, you can also mention, let me say, in terms of governance, yeah, you can mention here the Malaysian Code of Corporate Governance, yeah, MCCG, yeah.
Yes.
Was just revised in 2021, and you have here this base model and then this step-up procedure. Yeah, that's also here part. Yeah, you can also mention, for example, the Institute of Internal Auditors Malaysia as the professional body regulating here the internal audit approach. Yeah, because internal audit approach is highly related, is here connected, interconnected with risk. Yeah, when you think about later on, we will also have a question regarding what do we understand by the 3 lines of defense model. In risk management. Yeah, in risk management, the 3 lines of defense is that you have the operative level. Yeah, that's the risk owner. In each department. Then the second would be the risk management itself. Yeah, if you have the risk management as a department, yeah, with the chief risk officer and their staff. Yeah, and the third level would be the audit. Yeah, because audit is looking also into whether risk management is carried out in a company in first efficient way, and second also is it effective. Yeah. Yeah. And then furthermore, you can then say, yeah, there is even a 5 lines, 5-line defense model. Yeah. Then you say, okay, we would integrate a committee. Yeah. Then the committee would be the 4th step. Yeah. And then we have the board of directors or the shareholders or the AGM as the 5th level. Yeah. So you can here argue. Yeah. That's also very important as an exam tip. In exam, it's always about there is no just one right answer. Yeah. So you need to understand the concept. Yeah. You come up with a short overview, and then you explain. You clarify what you mean by your answer. You give always a clarification. Yeah? And that's here the best approach how you can answer the question in exam. Yeah? So far clear, right?
Yes, it is. Thank you.
Okay, yeah, then let us move on here to the second question. So second question, explain why risk is described as both input and an output in the strategic decision-making process. Provide an example for each. Yeah. That is also quite a thankful question or easy question, because sometimes, yeah, in part A, you have, I guess, 5 questions. Each question is about 5 marks. Yeah. And here you have mostly theoretical questions, whereas then you have a part which is mixed model, yeah, where you have a combination of theory and case studies, and then of course you have here the main part, the most important part is of course here the case study itself. Yeah, and for the case study, yeah, we have a separate boot camp where we discuss different cases really meticulously, and that's all tailored to Malaysian environment. Yeah, it's always about the Malaysian company, how they are composed of, what is here the organization, some background information. You have an explanation of a situation. Out of this, you must identify shortcomings, and then you analyze what they need to do, or how can they improve their risk management system. That's a separate part, yeah, because you need to understand all is not possible to discuss in just one boot camp. Yeah. So back to the question, yeah, input, risk as an input, yeah, risk exposure Yeah, by the way, risk exposure, that's a technical term. Yeah, risk exposure technically is that you have here mathematically, yeah, is risk exposure explained that you have the probability of a risk event happening multiplied by the severance, yeah, of the risk event. That gives you then the risk exposure. Yeah? Uh, the risk exposure, the probability is always given as a percentage, yeah, whereas the severity is given as a ringgit amount. So therefore, the risk exposure is always expressed as an amount. Yeah. So therefore, risk, of course, is existing risk exposures. They influence different types of strategies. Yeah? If you have a strategy which has a higher exposure, yeah, then of course you must find an alternative approach. Usually, this, for example, is done with a scenario technique. Yeah. Do you know how scenario techniques work?
No, I'm afraid not.
Not? Oh, never heard about. Yeah, scenario technique is that you have here that you define always several outcomes. Yeah, there is the most so the positive outcome. Yeah, then you have here the negative outcome. Yeah, and the most likely outcome. So best case, worst case, and most likely case. Yeah, and out of these three, then ultimately you arrive at the risk exposure. Yeah, that's how it works here in practice. How practitioners are doing this. Yeah? And of course, the risk assessment, when you think about, yeah, risk assessment is that you look precisely into, yeah, what are the root causes, what might be the effects, and so on. What are the consequences if I make the decision in this or that way? Yeah, and of course that shapes ultimately the strategic options. Yeah, because first you assess, and based on the assessment you do the decision, not the other way around. Yeah? And when you have the decision, of course, you look also, yeah, which resources do you need in order really to carry out this project accordingly. Yeah, because each project from the risk management perspective is seen as an opportunity. Yeah, and opportunity has always, yeah, an upside and a downside potential. Yeah. So what is an example, yeah, for this input? Organization, they launch a new product. Yeah, they want to exploit a new market opportunity. Yeah, and here they have to merge, yeah, to address here increased regulatory costs, for example. Yeah, that would be an input. Yeah, then it's about here a merger. Yeah, they want to launch the product quite fast. Yeah, and therefore, yeah, they need also to know, yeah, what are the costs here, yeah, when it comes to this this release of the new product in maybe in a new market. Yeah. So what is risk as an output? Risk as an output is then the strategic decision. They create new risks. Yeah. That's after you made the decision, then of course you have to look into the whole project once again, because based on the decision, yeah, it's like now you are at that track and you have to find out what risks are beside that track. Yeah, that's here risk as an output. Yeah, you implement here the strategy, and the strategy itself generates additional risk exposure. That is here meant by risk as an output. Yeah? Example, the new manufacturing facility, yeah, creates health and safety risks. Yeah, if you would not have invested in a new facility, you would not create new health and safety risk. Yeah? So therefore, in this connects or in this context, yeah, the risk is regarded as an output variable. Yeah? Does this also clarify the question so far? Okay.
Yes, yes, it does. Yes, it
Yes.
does. Thank you. Thank you.
Okay, yeah, just give me a short feedback here, then yeah, we can here move on. Yeah, you see, in the overview, I did it in that manner that I say risk as an input is always an influential factor, whereas risk as an output that creates new risks. Yeah, and risk as an input is always with this strategy formulation in the planning process, whereas risk as output is at the stage of implementation and execution. Yeah, you know, first you plan, then you revise, then you implement and execute. Yeah, and of course, during the execution, there might be new risks upcoming. Yeah, and you see here new factory triggers here new health and safety risk, or expansion, yeah, triggers environmental risk. A new IT system triggers cyber risks. Yeah? Okay, that's here to complete it. Yeah, here also the second question is here summarized so far. Yeah, and you see here the key insight is that risk management cannot just be treated as a separate function. Yeah, risk must always, because that's the lessons learned. Yeah, why we have this input and output discussion. Yeah, it needs to be integrated throughout all the strategic cycle, all the business model, or all the procedures going on in a company. Yeah. So it cannot be just standalone. Yeah. If you do risk management standalone, yeah, then it is a siloed approach. Yeah. Then it is let me say a standard risk management approach. Whereas when you integrate it, yeah, then it is already on enterprise risk management level, yeah, which is much more advanced. Yeah. So if you have further questions, then just let me know. Yeah, then we can dive even deeper. That's up to you. Wherever you want to have more insight, yeah, I can provide, of course. Yeah? So
can I ask a question? Can you provide an example of a risk as an input for a manufacturing company?
Risk as an input for a manufacturing company. Yeah?
Yeah.
That would be if for a manufacturing company, risk as an input would be if the company wants to decide. Yeah, usually you have always a manufacturing company has always to decide whether make or buy. Yeah, whether they make it on their own or whether they should buy it from outside. This so-called outsourcing. Yeah, and if you want to outsource, yeah, then risk is an input, because here you must find out what are the consequences, what is the risk profile of this outsourcing. Yeah. So far, clear? So first of all, you do the differentiation, yeah, between make on your own. Yeah, then you have a certain risk profile, and later on, yeah, you have also to find out what are the consequences for the outsourcing. Yeah, make the buy decision. Yeah. Clear so far? Hello?
Yes, clear. Thank you.
Yeah, it's just a bit yeah. If I don't hear you, then and in the background I hear some noise, then I think, hopefully you are not out of that the line is still stable. Yeah, you know. So therefore,
Yes.
yeah, if we communicate, then I know you are really present. Yeah.
Yeah, I'll be here for another half an hour, but after that, I think you can proceed. I mean, for the
Yeah,
other.
I will just discuss, yeah, as
Sure.
far as possible, yeah, and of course a
Absolutely.
lot is so far in written, yeah, because you have the document, you have access to the document. But of course, I explain also beyond that. Yeah, sometimes, yeah, it's yeah, very interactive. Yeah, if the students ask me in other classes, the students, they ask a lot, and then we have a discussion on that, and then we find out, and ultimately we summarize then the points together. Yeah, here we do it a bit the other way around, but doesn't matter. Okay. So, distinguish between internal and external stakeholder and provide 2 examples of each categories. Yeah. Usually this question is related that we have the so-called stakeholder mapping. Yeah, stakeholder mapping is also a very organized way to analyze, yeah, with which stakeholders you are dealing with, to find out what is their level of influence. Yeah, how important are they? Yeah, and how you should address them, how you should communicate them. Yeah, and therefore this triggers here also the risk management reporting accordingly. Yeah. And in principle, when you do stakeholder mapping, yeah, of course, we have internal stakeholder. They belong directly to the organization. They are employed. Yeah, they are also, let me say, the owner is also here regarded as when they are already shareholders. Yeah, then they are regarded here also as internal stakeholder. Whereas if you have an investment, someone who is just interested in investing in your company, yeah, then it is an external stakeholder. Yeah, but an external stakeholder can easily become an internal stakeholder. Yeah, directors, managers, they are also, for example, here, internal stakeholders. Employees, of course. Yeah. When we think about external stakeholders, then of course we have here outside. Yeah, they are outside the organization. Yeah, but they have a relationship with the company. Yeah, through transactions, through contracts, or they are impacted, influenced in a way. Yeah. So we have customers, of course. Customers, yeah, if they buy the product, yeah, they must rely on the product quality. Creditors, yeah. If you ask for a bank loan, yeah, then of course the bank is a creditor to you, and therefore has also some interest here in your company. Yeah, if let me say the level of financing is very low. Yeah, that is expressed with the gearing ratio, for example. Yeah, if the gearing ratio is quite low, then the bank would not influence your business decisions that much. Yeah? But if, let me say, they finance up to 60% of your whole entire company is financed by the bank, yeah, then the bank might even claim a seat at the board of directors to have direct access. Yeah? And of course, they work here with covenants. Yeah. For example, if you take out the loan, yeah, then you must assure them that you are able at any time to repay the loan amount, but also to repay the interest. Yeah, and first it's about to repay the interest or to pay the interest. So we have, for example, this ratio as covenant interest coverage. Yeah, interest coverage must be more than 3. Yeah, if it is not more than 3, the company won't be allowed to issue any dividends. Yeah, and with this, of course, the bank would influence your decision making. Yeah, you are not that free anymore. Yeah, so that you see here the importance of the stakeholders. They can vary accordingly. Yeah, we have also the suppliers. Yeah, we have the regulators, we have the tax authorities, and so on. Yeah, we have the general public. Yeah, if you have here the location, just think about the location of the company. Yeah, then you have the company might have neighbors, residential neighbors. Yeah, then they might be affected by the noise, yeah, of the trucks when they are delivering the goods and so on. Yeah, and here it has also to needs to be found a compromise. Yeah, in some countries it's like this, that after even if the company is working 3 shift models, yeah, but the delivery is not allowed. Yeah, any traffic is not allowed after 10 p.m. anymore. So that the neighbors, the residential neighbors, can have a good sleep, for example. Yeah, that's here also to consider so far. Yeah, just to give you some examples. Yeah. So then you have here also some narrative text, yeah, which is precisely explaining, yeah. Here, yeah, when you it is meant that you read at least one time through. Yeah. Also, by reading through, I would like to show you here a functionality. Yeah. Maybe you know it or you don't know it. Read out loud.
Internal stakeholders are those who are employed by or own the organization.
Yeah, you can switch on this read out loud function. Yeah, then you need not to read. Yeah, you can just listen to what the text is here. What the text is saying. This is quite comfortable insofar as in the evening maybe you are already a bit tired and you cannot focus here on really looking at the paper. Yeah, or yeah, at the screen anymore. Yeah, then you just load this and switch on the read out loud, and maybe beside you are cooking or whatsoever, and then you just listen to it. Yeah, that's already helpful to develop here a more deep understanding. Yeah, because at least you have once heard the text and some phrases and some content, of course, will always here be absorbed by the brain. Yeah, that works even unconsciousnessly. Yeah, you need not to do actively something. Yeah, you use this technology as well.
Not most of the time. I'm much more of a reader, but it helps that there is this technology and we can use that.
Yeah. Okay. Yeah, because what you need to do is that because it is a kind of add-in, yeah. So you have to add it to your browser, then it's working. Yeah. Okay. Yeah. Good. That's here. Yeah. You see, you can categorize here the answer accordingly, or arrange the answer accordingly. That you say who are the internal, who are the external stakeholders, what is their investment, and what is their expectation. Yeah, let us just take this table. Yeah, that's also quite important here, because it leads automatically to another follow-up question. Yeah, what about what is the risk about if we have here different interests, how we can mitigate the risk of clashing interests. Yeah, of course, naturally there are clashes in interests. Yeah, an employee is always about that they want to have a decent salary, they want to have job security, they want to have a safe workplace. Yeah, when it comes to the directors, they want to have a high compensation and influence and career progression. They want to have power in a way. Yeah? And external, a customer, they want to have value for their money. They want to have the security that they can rely on the quality itself. Yeah, that the products are safe. Yeah, and if you think about the stakeholder or the shareholder, the shareholder is not that interested that they want to pay high salaries. So therefore, there is a clash. Yeah. Also, the shareholders, they must be aware of the self-interest of the directors. There is an agency problem in between them, among them. Yeah. So that's here what this table also helps you to identify and helps you here. Or suppliers, of course, they are interested to get the timely payment. Yeah, that the relationship is ongoing. That there is also a trustworthy relationship. Yeah, from the company side, if you get here credit terms, yeah. The more favorable the credit terms is, so the later you need to pay, the better it is for you. So that's in contrast often with that what the supplier is willing to offer. Yeah, and then it's about negotiation. Yeah, you want, for example, 60 days net payment. Yeah, the supplier is asking for 30 days. Yeah, maybe you find a compromise and then you agree 45 days. Yeah, that's what in reality is here going on in between the different stakeholders of a company when they negotiate, when they discuss, and so on. Yeah. So let us move on to question 4. Explain 3 reasons why shareholders may not behave in a risk-adverse way despite being inherently risk-adverse. Yeah, this question is a bit more complicated. Yeah, because you have to analyze. Yeah, whenever you read an question, analyze the components. We need 3 reasons. Yeah, it's about risk aversity. Yeah, and why they are not behaving inherently risk adverse. Yeah, because you need to understand from the logic, everybody wants to avoid risk, so is risk adverse. Yeah, but they cannot behave just like risk adverse. Yeah, if you just purely want to avoid risk, yeah, then you don't find any opportunity. Then you cannot even make any profit at all. Yeah, here as an answer guidance, here it's about it's also addressing these asymmetric returns. Yeah. So the shareholder can receive dividends and benefit from the unlimited share price appreciation. Yeah. So therefore, for them, there is theoretically no limit on returns. Yeah, they can get 100%, they get even 1000% as a return. Yeah, if they invest, let me say, in a share, the share price is 1 ringgit 20, yeah, and then they get always a 20-cent dividend, and suddenly the share price is appreciating to 3 ringgit. Yeah, then they have here almost 300% return. Yeah, that's here the asymmetric return, and the downside potential would not be that much, yeah, because it is a solid blue chip company. Yeah, what's a blue chip company is, blue chip company.
Yes, I'm aware.
Okay, yeah, that's just that we can clarify such things as well. Yeah, because the opposite would be the so-called junk shares or junk bonds. It's usually with junk bonds related. Yeah. So limited liability, yeah, that's about that the losses for a shareholder is always kept with their investment. Yeah, whatever they pay in as a capital, initial capital, that's ultimately the worst case. Yeah, nobody can force them to pay for the losses accumulated. Yeah, if the losses are consuming the entire equity, yeah, then of course the company is forced to go into bankruptcy. Yeah, if they are illiquid, yeah, so that they cannot settle their debts anymore, yeah, then they have to declare bankruptcy. Yeah? So the downside in this case is limited, yeah, while the upside is unlimited. Yeah, and diversification of risk, that's here about that you have always to create a portfolio. Whatever you do, have always a portfolio. Portfolio means you approach always multiple investments. Here, investment is also meant, yeah, as an activity, as a project, as an investment in a market, in a technology. It's really in the widest sense of the term. Yeah? It's not just investment, financial investment. Yeah, usually investments, yeah, you associate immediately with financial investment. Yeah, and here, yeah, as a picture, don't put all your eggs in one basket. Principle shall guide you when it comes to diversification. Yeah, and you have, of course, to look into the risk profile of a company, whether there are specific risks, yeah, arising here. For example, fire, frauds, and so on. Yeah, that needs here to be addressed. Yeah. So, yeah, you have here this one, yeah, the effect on the risk behavior. Yeah, so when we think about the asymmetric risk, yeah, there is no cap, yeah, but potential gains. Yeah, welcomes risk taking for the prospect of exceptional returns. Yeah, that's of course. Yeah, then I invest in this company. Yeah, that there is almost no downside potential. Yeah, when you think about stock investment in Apple shares, you cannot do that much wrong. Yeah, because in the last couple of years, even decade, it was always up. Going up. Of course, there are some phases where there is a correction, yeah, but the trend is always appreciation. Yeah, if you think about the share price of Apple, yeah, that's skyrocketing. Yeah, so you have exceptional returns. Yeah, always, yeah, when you look into the past, yeah, then of course the picture is always clear. Yeah, to anticipate for the future, that's a bit tricky. Yeah, because right now, of course, some investors, they might say, oh, the share price is much too high, it's too risky, maybe it will correct down and then I'm at the loss. Yeah, of course, it's always about the right timing as well. Yeah, the timing drives here returns. Yeah, that we need to know. Limited liability. Yeah, here the downside is kept. Yeah, and reduces fear here of catastrophic personal loss. Yeah, so you don't operate, for example, as a sole proprietor. Yeah, if you operate your company as a sole proprietor, then you have unlimited liability. Yeah, if you convert your company into a Sandren per heart, yeah, then your liability is limited exactly with the amount which you pay in, not more and less. And they cannot grab your personal wealth. Yeah, it's company and yourself. They are two different entities. Yeah, and that's about here limited liability. Yeah, diversification. Single company might fail. Yeah. If you have a portfolio, let me say with 10 companies, yeah, and one fails, yeah, then you are not that much affected. Yeah, that's here the case. So then let's look into the question 5. Define limited liability and explain how it can encourage risk-preferring behavior among shareholders. Yeah. So first you need to come up with a definition. Yeah, then you explain how it is related to the risk, to the risk behavior itself. Yeah. So definition of limited liability. Yeah, that's a legal protection where the shareholders' maximum loss is kept. Yeah, the shareholders cannot be forced to provide additional funds. Yeah, even if the company becomes insolvent. Yeah, and it applies both to public and private limited companies. Yeah, only the sole proprietor, yeah, and some cooperatives, they have unlimited liabilities. Yeah, other legal entities, their liability is kept. Yeah. So how encourage this with risk preferring behavior? Yeah, it creates asymmetric payoff, unlimited upside, limited downside. That might even lead, yeah, that they say, oh, now I can take full risk, yeah, with that amount which I have paid into my company. Yeah. Personally, I'm risk adverse or risk neutral, but with the company, with that amount, what I paid in, I'm risk seeking. Then they can say, okay, I put, let me say, 1 million ringgit in the company, and then the company is approaching or wants to realize projects and do business and finds here good business opportunities. Then they can even be very aggressive. Yeah, because the worst what they can lose is the 1 million. Yeah, but with the 1 million, they can create a high leverage. Yeah. So bankruptcy risk, of course, becomes more acceptable when potential gains are high. Yeah, yeah. What is the case? Yeah, if the worst case comes, yeah, then it's bankruptcy. Yeah, of course, to be bankrupt in Malaysia is not regarded. Yeah, it's really damaging your reputation. Yeah, and you might even be blocked to open up a new company. In Europe, yeah, it's regarded even a business model. In Europe, it's really like this, that some companies, they calculate to go bankrupt, or to open up this Chapter 11 procedure, where they ultimately agree then with all their creditors only to pay, let me say, 20%, and then they continue business, but they can get rid of their debts in one shot by this Chapter 11 procedure. Here another example is the financial crisis. Here the banks, when you think about how the financial crisis evolved, the banks took excessive risks, especially the investment banks. They were speculating. They didn't regard even the risk what is in, and they speculated with so-called, what was this, the asset-backed securities. Asset-backed securities, this is a special kind of shares. They securitized loans, housing loans, which had a high risk of defaulting, and made another investment vehicle out of that, and that they sold. And ultimately, what happens in America, the housing market collapsed. There were a property bubble bursting. And so these papers became worthless. And they had already distributed these papers to all over the world. And that was here the starting point, or the background here of the financial crisis. And ultimately what happens, the public, the government had to bail out a lot of banks. Of course, they didn't bail out the main investment bank, which was this, what was, it was not right now, I don't know the name, but the one major investment bank collapsed. That's here about limited liability and risk-preferring behavior. The link to risk-preferring behavior. You see here, for example, that's what I mentioned at the beginning also, the scenario technique. Scenario technique is about that you have here the conservative strategy. That is 10% potential return. Is, for example, the 1,000 pounds. Maximum loss would be 10,000. If you invest 10,000, what you can win is the 1,000. High risk strategy is that you can have a loss of 10,000, but you can win here. You can win here 500%. So out of the 10,000, you make 50,000. What is the risk strategy if it is a failure? That's a worst case. That you go bankrupt. You lose just the 10,000, not more and less, and that's it. So which scenario would you follow, or would you like to prefer to follow?
I would certainly want to follow, a loss that is kept. So I from what I can see, I think it's whether it's success or failure, higher strategies, as long as the loss is kept.
Okay. So you are never going to open up a sole proprietorship.
No.
So it's always then a private limited company, and that makes sense. Okay. Explain what is meant by the asymmetric information problem and how it can lead to opportunistic behavior by organizations. We have the asymmetric information and opportunistic behavior. That's in a way also intertwined. So therefore, this question is exactly looking into that relationship here. So what is the definition? Situation where one party in a transaction has more or better information than another party. So what is an example for that? Daily life example. For example, if you want to buy a second-hand car, Yeah. Yeah, the second-hand car may work or not. Yeah, the seller of the second-hand car exactly knows where there might be some pitfalls. Yeah. As a buyer, yeah, what you can do, you can go to a repair shop, to a workshop, yeah, and let the car checked. But that doesn't guarantee that they find out all the problems which the car might have. So therefore, there is an asymmetric information problem, yeah, because the seller knows much more than the buyer ever will know. Yeah. And what the buyer can do, yeah, can only trust or say, no, this is too risky. I never buy a second-hand car. I always buy a new car. Yeah. That's here an example. Yeah, creates imbalance. Yeah, what is the consequence of this? Yeah, creates an imbalance of power. Yeah, of course, in that case, the one who has more information is more powerful. Yeah, because they have more knowledge. Yeah, they are both stakeholders in the case. Yeah, but one stakeholder is powerful, more powerful than the other. According to the market efficiency theory, there should not be any imbalance of power or knowledge. Knowledge shall also be available at any time, free of cost to anybody. Yeah. In Europe, they follow this principle. Yeah. In Europe, for example, when you study, you have access in continental Europe. In British Europe, not. British, they are very, very restrict here too. Yeah. So a form of failure, market failure. Yeah, it's a market failure because it is not efficient. Yeah, efficient is if there is really a trade or transaction ongoing on the same level. Yeah, so that the decision making is an easy one. Yeah. So how it leads to opportunistic behavior? Yeah, of course. Yeah, when an organization has more information than another one, then of course they exploit here the lack of anybody else. Yeah, they exploit here the stakeholders' lack. Yeah, even if they are for or are asked to behave ethically, yeah, that has just in a peripheral way to do with ethics. Yeah, because it's natural that they take their advantage if there is a knowledge advantage, yeah, that they use it. Yeah. So example, yeah, company makes a product less safe than it could be to save cost. Yeah, nowadays it's even like this. They don't even make it less safe or reliable. They build in planned obsolescence. That means, yeah, whenever you buy, for example, air condition, yeah, you can be sure that within 3-4 years, yeah, your small device is not working anymore, because they plan, yeah, that after a certain time it will break. Yeah, the condensator or whatsoever, one part will break. And it doesn't even make sense to repair it, yeah, because the repair might be even more expensive than just to buy a new one. And with this business model, they have always continuous business, because every 4 or 5 years, the customer must come back. But from the technical perspective, you could manufacture an air condition device so that it lasts forever. Yeah, and the same is often with cars as well. You just think about the cars, how they are manufactured, let me say, some 100 years ago. There are still old timers properly working. Yeah, they were produced 100 years ago. They were produced, let me say, in the 1930s. Yeah, their metal sheet was thick, almost like a finger. Yeah, now you have not even a thickness of a nail. Not the thickness of your fingernails. Yeah? Just to compare it. That's really a pretty difference here in quality. Yeah, although we made a lot of progress. Yeah, when you think about this electronics. Yeah, but the electronic lead ultimately that you can even plan when the service stops. You understand? And then you have to subscribe. And meanwhile, some prime car maker, they have such a subscription model. Yeah, if you want to have the safety, driving lane assistant, then you have to pay on monthly basis that this tool is working in your car. The tool is there, but you have to pay extra. Otherwise, it's not working. If you don't pay, they switch it off. And that is only possible with an electronical parts. In the previous times, such a device was not available. But in former times, you could even repair your car on your own. If you have a bit of a technical understanding, you could do it on your own. Nowadays, you cannot anymore. Customers cannot assess true safety or reliability before purchase. They have in a way to buy the product, and later on they find out they will find out whether it was really reliable, whether it's really offering value or not. And mostly, the goods are nowadays designed for a specific time, and then it's just to be thrown away. Organization saves money by exposes a customer to unacceptable risks. For the company, of course, even if they downsize here the service itself, they save cost. And maybe it goes that far, that it becomes unacceptable risk for the customer. For example, a lot of car manufacturers, when they wanted to launch a new car model, they launch it quite fast. And maybe you have also figured out that the first series of a car is often with high risk that there are recalls necessary because one component was not really fully developed. That's here a good example how this opportunistic behavior is. For the company, it's good, because they have the car very fast on the market. But for the customer, it might not turn out as a good thing. So justifies regulation. Market forces alone cannot address this imbalance. So what does it mean? The market isn't regulating this, so therefore you need a regulation. And therefore the regulation would be justified to influence what's going on in the market. So that's here this one. Here product safety, true safety risks. Must trust marketing claims. Marketing, the advertisement is always promising. But the delivery might be a different one. And that you have here to find out, and that's an example here from asymmetric information problem as well. Then let's move on here to the question 7. Define public goods in the context of risk management and provide 2 examples relevant to organizational risk management. So, definition of public goods: goods or resources that benefit to the society as a whole, not just individuals or organizations. They are characterized by 2 key properties. What is a public good? There is a characterization according to theory. They are not non-excludable, cannot prevent people from benefiting once provided, and non-rivalrous. That means it doesn't diminish in availability for others. Usually it was, usually it is the air, it doesn't diminish, and it was also water. But now also water in some regions, it is a scarce resource, and therefore it becomes that it is traded. You have to pay a price. But originally, if water was free, the rainfall, you just store it and then you drink it, or you can even drink it directly. So that there was not the necessity to pay here for water. So therefore, it was a public good. Yeah, but now not anymore. Air is still a public good. Yeah, I'm just waiting until the air is taxed.
Yeah.
Yeah, because if they don't find any alternative, any new taxes, they can come up with that. But that's not just a joke, yeah, that the air is taxed. Yeah, because if you think about in Europe, they have the so-called CO2 emission certificates. So as a steel company, you have to buy a license that you have the right, for example, to emit 1,000 tons of carbon dioxide. So therefore, for them, the air is also taxed. Yeah, due to tax, due to payment. Yeah. So yeah, that's question 7. Yeah, then what is the public goods problem in risk management? Yeah, organizations may not adequately protect public goods. Yeah, when only considering private benefits and costs. Yeah, yeah. For example, a chemical industry in Bangladesh, they are not caring about what they release to the environment. They use just the water, and then it's contaminated, and then it's just released without further treatment, yeah, into the river and ends up, let me say, in the ocean. In a lot of countries, unfortunately, this is the case. They have only very limited environmental standards. Yeah, and so they don't protect here this public good water, river water, yeah, because river water is still a public good. Yeah. And yeah, also the air. Yeah, just imagine in some areas in India, yeah, you cannot even breathe the air anymore because there is so much smoke. Yeah. And who is suffering? The general public is suffering. Who is creating this? Maybe some few companies. Yeah? And they are not paying for this pollution. Yeah? So market forces alone cannot ensure proper protection. So therefore, here we also need strong regulation. Yeah, when you think about the Switzerland, they have one of the strongest environmental regulation at all. Yeah, therefore, if you visit Switzerland, then you can see how beautiful it is, how clean the rivers are, how clean the lakes are, how fresh the air is. Yeah. It makes a difference, yeah. And then you can compare this, let me say, to Bangalore. I think that's like day and night. Yeah. So, example, yeah, the environment, clean air, water, natural ecosystems that benefit everyone globally. Organization may pollute if only considering private production costs. So therefore, what we are doing in terms of regulations, yeah, we try to arrange here on global level yeah, some protocols, some agreements, yeah, emission agreements. Yeah, for example, the Kyoto Protocol is about reducing here the emission of carbon dioxide. Yeah, yeah. Example 2 would be financial system. Yeah, when you think about the financial system, the system itself shall also be a public good. Yeah, because it should benefit all the economic participants. But if you have an individual bank, yeah, which takes excessive risks just for private profit, yeah, and this is a huge bank, yeah, this is a so-called system. This bank has a high system relevancy, yeah, under the theme too big to fail, yeah. Such banks often they take excessive risks, yeah, and they can even shake the whole financial system, yeah. And then because of the wrongdoing of one bank, yeah, may cause then damage to a lot, yeah. And that's exactly what happens here in the financial crisis in 2007 and 2008, yeah. And yeah, you see here, private risk taking can damage the entire economy. Yeah, and therefore we have here the international financial regulation, the Basel Accords, yeah, the Basel standards with Basel 2, 3, 4. Yeah, but still Basel, yeah, the countries, they have to embed it into their local law. Yeah, if a country is rejecting this, yeah, yeah, then the regulation can as good as it is, yeah, but it's not effective. Yeah. For example, in Europe, of course, Basel throughout all countries are committed. Yeah. Here, when you think about Thailand, Thailand is not committed to Basel. So the banks, they are not following that standard. Yeah. In Malaysia, they're following this standard. Yeah. So, yeah, that's here this question. Yeah. Yeah, 2 examples there. There are some other examples here. Yeah. That you have here. Yeah, you see, you can organize in exam, yeah, key examples of public goods. Yeah, what it is, who benefits, what is the risk behavior, and what shall be the regulatory response. Yeah, and here, based on the 2 avenues, one is about the environment, the other is about the financial system. Yeah? Then you have here also some ideas how you can approach here these questions so far. Yeah, then question 8. Describe.
I have to jump off now.
Okay, yeah.
Yes. So I don't know whether if you want to carry on for the purpose recording, that's fine. But I'll have to actually leave at the moment. I've got something.
Yeah. It shall not be an issue. I will continue with the delivery. I will then have the complete recording. Yeah, and then later on you can also listen to the recording. I will provide you the recording in Google Drive. Yeah, and you can access it at any time. You see, if you go really into detail, yeah, into the question, then 2.5 hours for 25 questions is not that much. Yeah, because it is a combined delivery. Yeah, it's really from the practical perspective of an exam, how you deal with the question. I don't know whether you get this with MAICSA. I don't think so, because they just say, okay, you have to relate to this chapter, you have to relate to this chapter. Yeah, we accept that you give a definition of compliance management, for example. Yeah, but not precisely how you should write it. Yeah, because here you have really this extra step that you have a guideline how you can use even sentences for your exam. Yeah.
Yes, totally understand. Totally understand. Thank you so much.
Okay, yeah, then I continue here with the questions for another 1.5 hours. Thank you so much that you showed up. I hope it was a fruitful insight. Yeah. And by the way, yeah, tomorrow I would start to discuss the case studies accordingly. Yeah, case studies in a similar way. If you have just a minute, then I can even show you how this works. Yeah, you have here all the background to the case study. Then you have 5 questions to each case study. Yeah, really chapter related, and then you have here the practical approach and a lot of practical examples as well.
Yeah, I'll try to see if I can join that as well. But thank you. All right, thank you.
Okay, have a great evening. See you. Yeah, see you soon.
Thank you so much.
Thank you. Bye. Yeah, then let's continue here with question 8. Describe the role of compliance management in relation to risk management regulation. Yeah. So first of all, here you are asked to come up with a definition. What do we understand by compliance management? So compliance management is here that the process itself, to ensure that you are adhering to laws, regulations, standards, policies, procedures, and so on. Yeah. And it bridges here the gap between the regulatory requirement and the organizational practice. Yeah. Furthermore, it forms part of the so-called GRC framework approach. Yeah, that's about governance, risk, and compliance. So, which key roles do we have in relation to risk management? Yeah, we have here, of course, the role of monitoring. So you need to track changes and so on. Yeah. You have also the role of implementation. Yeah, you have to translate here the regulation into an operational procedure. You know, the framework itself doesn't guide the individual people how to do it. Yeah, how to do it, it needs an operational procedure. Yeah, the so-called SOPs. yeah, then it needs also the verification. That means, the rules shall follow here by audits, by controls, by reporting. Yeah, the best rule is only as good as it is executed. Yeah, and it is controlled. Yeah, of course, in some business environment, you need less control, yeah, because the staff might be more self-driven and more aware about. In others, yeah, you need really to control step by step. And on regular basis, yeah, you have an internal audit or even also an external audit. Reporting, yeah, reporting is about that you communicate the compliance status here. Yeah? And what's also very important is that you permanently upskill yourself in terms of compliance management. Yeah, you have to educate your staff, yeah, on new regulatory obligations and so on, and on the expectation itself. Here, there is also a separate standard, yeah, for compliance management under the ISO regime. Under the ISO regime, we have the 19600, 2014, here edition, which gives you a proper guideline in terms of how you build a first-class compliance management system. Yeah, it's an international standard. Yeah, it covers here board and senior management, leadership requirements. It addresses the roles, the policy, objective, communication, training. Yeah, it's all covered like the risk management standard. Yeah, so very comprehensive. And you can also here seek for certification of your compliance management system. Bigger companies, they are also certified according to this standard. Yeah? What is the consequence of non-compliance? Yeah, what is the worst case? Yeah, you can face here penalties. You can face here financial sanctions. Yeah, that you have to pay a fine. It can even to go that far that if you do it repetitively, for example, health and safety. Sorry, health and safety. It's like this. Yeah, if you don't follow here the standards, yeah, you can also be imprisoned. Yeah? So reputational damage, yeah, loss of stakeholder trust, operational disruptions. Yeah, these are other consequences of non-compliance here in your management system. Yeah, yeah. You see here what is the outcome. Yeah, if you identify. Yeah, here the compliance management. Yeah, then it's about regulatory register. Yeah, you have the compliance obligation inventory. You implement. Yeah, that's the compliance policy. That's the control framework. That's leading here to trained workforce. You monitor. That's about the audit reports. That's about compliance dashboard. Like we have risk management dashboards. You can also have compliance dashboards, yeah, incident records. You report, yeah, you have board reports, regulatory submissions, compliance certifications. Improve, yeah, remediation plans, enhanced controls, updated policies. That's here so far regarding the compliance management. So how it is embedded within the GRC, yeah, GRC stands for governance, risk, and compliance. So governance is about board oversight, strategic direction, policy framework, and accountability. Whereas risk management is classically dealing with the procedure itself. You identify, you assess, you treat, you monitor. Yeah, and compliance is regulatory adherence, policy implementation, control, verification, and non-compliance handling if it happens so far. Yeah, then let's move on to the next question, which is question 9. Question 9 is explain how bankruptcy costs and cash flow fluctuations can motivate shareholders to value effective risk management, despite their potential for risk neutral or risk preferring behavior. So bankruptcy costs and cash flow fluctuations. Yeah, often, of course, if you have, let me say, a high cash flow fluctuation or even a negative cash flow, yeah, then of course this drives you towards the risk for bankruptcy is becoming higher. And in the case of a bankruptcy, yeah, then it's not just the bankruptcy itself. There are additional costs coming up. Yeah? So why shareholders may not be risk adverse? Yeah, just to recap, yeah, that we had already in a former question. Yeah, it's about the asymmetric returns, it's about the limited liability, and it's about diversification. So bankruptcy costs as a motivation. Yeah, what's the definition of bankruptcy cost? All costs which results when the situation comes up that the company is distressed or already insolvent, so they are illiquid. They don't have any liquidity anymore. Yeah? Direct costs are legal fees, court costs, administrator fees, asset valuation, liquidation expenses. Yeah, that's direct costs which come additionally up if you are bankrupt. What are indirect costs? Of course, loss of customers, suppliers, credit tightening, key employees you will lose. Yeah, reputational damage you might have definitely, and the management is also distracted. So what is the impact? Yeah, when you think about estimated 10 to 20% is accounting is made up by the bankruptcy cost. Yeah. Of the firm value which can be or will be destroyed in that case, in that event. Yeah? What is the shareholder motivation? Even diversified shareholders lose value when bankruptcy costs destroy company value. Yeah? Effective risk management reduces here the probability of incurring these costs. Yeah? What about cash fluctuation? Yeah, cash fluctuation, cash is the variability in timing as well as in the amount of cash coming in or flowing out of an organization. That's about the cash flow as a definition. So what is the problem with this? Yeah, it might force here liquidation of assets at unfavorable prices. Yeah, you don't get the market price if you want to sell a machinery very quickly. Yeah, because then the other party knows that you are distressed, and then they say, I only buy, let me say, for 50. Yeah, you are asking for 70. They say, no, I only buy for 50. Yeah? Profitable investment opportunity, and you have also here increased borrowing cost. Yeah, the more volatile the cash flow is, the higher interest charges will be levied on you by the bank when you take out the loan. Yeah. Shareholder motivation, usually they prefer, of course, stable and predictable cash flows, because that supports higher valuation, and even sustainable dividends. Yeah, so therefore, you have here to look into or to make sure that you can generate constant cash flows. And risk management can help you to evaluate. And see what is right now the status quo, why maybe we have fluctuating cash flows, what can we do, how we can mitigate that so that we can here improve the situation. You see here direct costs. Typically 3 to 7% of the firm value is directly consumed by the process of bankruptcy. Then indirect cost, we have another 10 to 15% value destruction. That just as a guideline. You see here volatile cash flows. What are the negative consequences? You are forced to sell off sales at bad prices or low prices. Missed investment opportunities, higher borrowing costs, dividend cuts, share price drops, difficult strategic planning leads to a lower valuation. If you have a stable one, of course, much more plannable leads here to a higher valuation outcome. What is the the next question is quite a thankful question. Discuss the advantages and disadvantages of self-regulation as a mean of managing organizational risk. Why do self-regulatory systems often fail? Yeah, so therefore they say, yeah, it's because risk management is often done here on voluntary basis. So voluntary basis is based on self-regulation. Yeah, there is no governing body who exactly says you have to do this or you have to do that. If you don't do this, then this is the consequences. Yeah? So definition of self-regulation. That's a process where an industry or profession monitors and enforces its own adherence to standards. Yeah? So they decide whether they want to be compliant or not, and to which or to what framework they want to be compliant. Yeah, but all on voluntary basis. So voluntary codes of conduct, industry associations, self-regulatory organizations. Yeah, it's the alternative to direct government statutory regulations. What is the advantage of self-regulation? Yeah, it can be very appropriate. Yeah, so the industry expert, they know best what they need, yeah, as a risk management tool. Lower compliance cost. Yeah, it's much more flexible. Yeah, tailored rules. Yeah, you only implement what you need and you follow what you need. Speed and adaptability. Yeah, is much faster here to set up a completely free risk management system as if you are bound to a specific framework. Yeah, the best approach is always a hybrid approach. What does it mean, hybrid approach? Yeah, you look into several frameworks and combine elements, whatever fits you the best. Yeah, so you combine ISO with COSO and so forth. Yeah. Yeah, industry buy-in. Yeah, if it is more flexible, then there might be a greater acceptance when rules are developed by some peers. Yeah, cost saving for government reduces the need for taxpayer-funded regulatory agencies. Yeah, that you can also mention here as an advantage. Yeah, if you don't have a mandatory system, yeah, you don't need an oversight, which comes at extra cost. Yeah. So disadvantages, of course, limited enforcement. Yeah, you cannot enforce anything. Yeah, conflict of industry. Yeah, the industry may prioritize their own interests over public protection. Free rider problem. Yeah, that's another disadvantage here. Non-participants can undercut those who comply voluntarily. So that means, if you follow a standard on voluntary basis, of course, it comes with some cost. It's not free of cost. Yeah? And if another company doesn't follow anything and doesn't implement anything, yeah, then they have here some advantages. That is here meant by free rider problem. Lack of accountability, less transparent than statutory regulation. Capture risk, yeah, here the regulation become dominant and powerful for industry players. So why self-regulatory systems often fail? Yeah, because if there is no mandatory, yeah, then there is no incentive, yeah, to follow here, because it is at your own expense. Yeah, weak sanctions. Yeah, cannot match statutory penalties. Yeah, reactive, not proactive. Often respond only after scandals. Yeah, historical example. Yeah, UK finance service regulation in 1980s, 1990s. This failed. Yeah, and that was then replaced by the Financial Stability Authority statutory regulation. Yeah, to reduce here this self-regulation. So then we go to question 11. So question 11 is about also quite often coming up in a similar way in exam, yeah, systematic, unsystematic risk, and so on. Yeah, here it's about explain the concept of systematic risk and financial market contagion. Yeah, use the global financial crisis to illustrate your answer. So systematic risk that problems in one country or institution can have global implications, arises from interconnected nature of financial markets and institutions, creates too big to fail institutions who might collapse, whose collapse might threaten here the entire system. That is here what the systematic risk is about. Financial market contagion. That's here about the spread of the financial problem from one market to another. Rapidly cascading through or across borders and market segments, driven by loss of confidence, information, uncertainty, and interconnections. These are here some bullet points which you should mention in your exam. So how it is related, because that's the second part here of that question. Use the global financial crisis to illustrate. That's here. The financial crisis started with rising US mortgage default rates. That was a very small issue. Of course, some mortgage loans can default. But that's not a tragedy. So, but in this case, they spread to mortgage-backed securities. These asset-backed securities and into lending market, into global lending markets. So there was then a loss of confidence, because it was spread out from US to Europe to Asia. Even currency and commodity markets were involved. And what was the result? The result was that we ended up in an economic recession. Trillions of US dollar or euros were lost here in the equity markets. That's here this question. You see here that you see also the different phases. It was in 4 phases. The origin was in 2007. Then in August 2007, it spread. And 2008 was then the crisis itself. You see, Bear Stearns were sold. Lehman Brothers, they were bankrupt. That was the water drop, which spoiled them, and the AEG was rescued, and then afterwards, 2008 and 9, governmental bailouts worldwide, to avoid here a great recession like we had in the 1929, or in the 30s, of the first of the last century. Then we are looking further into question 12. Compare and contrast the 4 main types of global regulatory principles, rules, guidelines, principles, outcome-based regulation, and risk-based regulation. So rule-based regulation, that's about definition, detailed specific requirements, the characteristics, it's always quantified, clear boundaries, very prescriptive. You have here within a certain time, you have to fulfill this and that. The advantage is clear expectation, certainty for shareholders, straightforward in terms of compliance and enforcement. But it comes also at a disadvantage. It's inflexible, can stifle here innovation, encourage checklist compliance, may become outdated. If it comes as compliance, a stick in the box approach, then rule-based is not the best. Guidance, definition, non-binding recommendations, characteristics supplementary to formal rules. Provides practical direction, soft law approach. Advantage, very flexible, can be updated quickly. Disadvantage may become contradictory over time. So that it is even a bit in conflict with the framework itself, because the interpretation of a standard might then even violate the standard itself, for example. So principle outcomes-based regulation, here high-level statements of desired outcome without specifying how you achieve compliance. They just say, we want this level of compliance. How you do it, it's up to you. characteristics, qualitative terms, fair, reasonable, and such terminology is used here to describe the outcome, the desired outcome, focused on spirit rather than letter of law. Yeah, so highly adaptive, discourages creative compliance, and allows here innovation rapidly to happen. What is the disadvantage? Yeah, it might be vague, and this vagueness might create uncertainty. And ultimately, you might end up with higher compliance costs because you need more experienced people to deal with, because they need more judgment, they need more expertise. Difficult to manage, to measure here the achievement. So what is risk-based regulation? That is targeting here based on activities and the entities posing always the greatest risk. So you differentiate whichever sector or industry is exposed to the highest risk. Therefore, these you regulate more tightly. Characteristic operates at design and operational level, prioritizing here resources based on risk management. Advantage, efficient resource allocation, and appropriate responses. Disadvantage, it may miss here low probability, high impact risks. That's here the question 12. So we just reached halftime. Then let's look into question 13. Question 13 is about the purpose and scope of ISO 31000-2018. So what key changes were introduced in the 2018 update compared to the original standard in 2009? The purpose is to provide guidelines for managing risk in all types of organizations. So not just a stock-listed company, not just private companies, also public companies, also governmental institutions. It's universally applicable. So support achievement of objectives and creation of shareholder value. Provides here international benchmark for good risk management practice. So it's widely recognized in the industry. Scope applicable to any organization, regardless the size, activity, or sector. Provides principles. So it's a principle-based approach, framework, and the process for risk management. Not certifiable, but provides benchmark for and improvement guidelines. So key changes, that was shorter and more concise, simpler language, greater emphasis on top management leadership, increased the focus on integrated nature of risk management, and greater focus of creating and protecting the value. And also emphasis on human and cultural factors. That was so-called a few updates from the original version. Then let's look into question 14. Describe the COSO Enterprise Management Framework. What was its initial focus and how has its scope evolved since 2004? You see, was founded in 2004. Background, it was the committee of the sponsoring organization. It was an initiative of US private sector organization, such as ICPA, similar to CPA, the IIA, the internal Institute of Internal Auditors, and some financial institutions as well. It's about the global influence on governance and risk. Initial focus, originally focused on financial reporting, and support for internal control and fraud detection and fraud avoidance and so on. Protecting and enhancing shareholder value. In 2017, major update. Here renaming Enterprise Risk Management, ERM, not COSO 1, COSO 2, integrating with the strategy and performance, highlighting the risk strategy setting and the performance here that they are very important for a functioning of risk management. 5 interrelated components. They built it here with components and principles. The governance and culture is one component. Strategy and objective setting is one performance. Component. Performance is one component. Review and revision, information and communication and reporting. And below these 5 pillars, we have always 20 principles, and they are then regulated in quite a detail. In my overall lecturing, in the entire course of risk management, I deal here in particular in more detail even, and provide also here slides and visualized pictures and illustrations, so that you can easily get here the information. Moving on to question 15. Explain why international risk management regulation and standards are necessary in the modern global business environment. Provide at least 3 reasons. Such a question was repetitively addressed in exam already. So reason 1, cross-border operation and global interconnectedness. So modern businesses, they operate on global level, multinational companies, MNCs, and therefore also we have here global supply chains. Financial markets are interconnected. The free in a lot of areas, there is the so-called free movement of capital. Free, and that means that you can invest at any place in any country wherever you are interested in. Some they are very restrictive, especially when foreigners want to invest in a domestic market. Then they have to fulfill extra standards. So example. Without international standards, regulatory arbitrage allows firms to exploit weaker jurisdictions. And example is the financial crisis showed how US subprime mortgage risk affect the global financial system. Second reason is about the global public goods requiring coordinated protection. We already discussed what we understand by public goods. So it's about here mitigation of environmental risk. It's about the financial stability. National regulation alone cannot protect against trans-boundary risk. So therefore, an example would be the Paris Agreement coordinates international environmental protection. Then at least 3 reasons. Then we look into the third reasons as well. Level playing field and fair competition. This is about international standards. Prevent race to the bottom in regulatory requirement. Ensures different companies compete on equal terms. That is here meant. Then, of course, you can also address here stakeholder confidence and market trust, as well as efficient response to emerging global risk. That can here be also mentioned as another reason. Whereby cyber risk and so on, we will deal in a later bootcamp in more detail. So then let us look here into some further questions. We have here question number 16. Question number 16 is about discuss the cost and benefit of risk management regulation. Under what circumstances might regulation be considered over-regulation? Also with regulations, you can really shoot with a cannon to a bird, and that would be then considered as over-regulation. So what are the benefits? Of course, protection of shareholders. Market confidence is growing if you have a good risk management regulation. Systemic stability can be guaranteed. Corrects market failures. levels here the playing field. Yeah, so that we have here consistent standards. Yeah, prevention of the value. Yeah, ensures here fair competition by applying consistent. The cost of prevention typically is far less than cost of failures. That is here the prevention value. Yeah. So what are the costs of the risk management? Of course, you have direct compliance costs. Yeah, for example, staff time, training, technological systems, IT landscape, documentation, audits, and so on. You have opportunity costs. What are opportunity costs? Costs, they divert from productive activities, innovation, and growth. You have also a regulatory burden. Yeah, that is regarded as cost. Yeah, this proportionate impact on smaller companies. Yeah, so therefore, there are step-up processes recommended so that you don't overburden here, especially smaller organizations. Reduced innovation. Yeah, prescriptive rules might stifle here the development of new products. Regulatory uncertainty. Yeah, cost of adapting to the changing requirement. That comes additionally with costs. Yeah, unintended consequences. Yeah. When regulation becomes over-regulated, yeah, then we have disproportionate costs. We have diminishing returns. Innovation is suppressed. Yeah, the competitive advantage might be lost. Yeah, and also regulatory capture. Yeah, it's very challenging. Yeah. And what would be often the result? Yeah, that it becomes that the box ticking culture evolves, so that they just do. It's that much to do. Just tick in the box, and tick in the box. Yeah. So then let's move on to question 17. So question 17, explain the role and the significance of Basel Accords in managing global financial stability risks. What are these accords particularly focused on? Internationally active banks. Yeah, role of Basel, primary source of international regulation for global financial stability. That was negotiated by the Basel Committee. The G20, the most important countries of the world, the most powerful one, the G20 countries, they are here representing Basel. Yeah, and they are under the patronage of the Bank of International Settlement. Yeah. So set the requirements for capital resources and risk management practices. They aim to prevent financial crisis. If that fails, provide financial buffer. So that means minimum key requirements, minimum capital ratios, liquidity requirements, leverage ratio limits, risk management standards, and stress testing. These are key requirements under the Basel regimes. So focus on internationally active banks, of course, because if you have, let me say, a bank which is operating in various countries, then they can be very influential. So it's a key source. If such a company, such a bank would fail, would be a key source of financial market instability. Because problems can spread here rapidly across the borders. Usually the markets are meanwhile so much interconnected. It's not just the interconnectedness among different financial instruments. It's also about different countries, different market, different segments. Also, let me say, the property market has influence to the share market. The share market has influence to the bond market, and so forth. So then question 18, critically evaluate the stakeholder process to understanding the importance of risk management. In your answer, discuss how different stakeholder groups invest in organizations and what return and protection actions they expect. Consider the potential conflicts that may arise between different stakeholder groups regarding risk preference. Yeah, you have here an overview, the stakeholder approach. That this question is addressing the stakeholder approach. Organization exists within a network of relationships. Stakeholders invest in various resources, expect corresponding returns and protection. Yeah? Risk management serves here to protect the diverse stakeholder interests. So what are the key stakeholder groups and their investments? Shareholder, of course, invest financial capital, expect returns, dividends, and capital appreciation. Seek limited liability protection. What about employees? Invest human capital, time, skills, expect fair wages, safe conditions, job security, and so on. Yeah, a bit, this is here repetitive to another question. The key conflicts, we can here highlight that's about risk preference versus the key conflicts. Here we have shareholders versus creditors. A shareholder may prefer higher risk for higher returns. The creditor prefers lower risk to protect fixed claims. What is an example? Of course, shareholder, they prefer a high dividend. Yeah, the creditor, the bank, they don't want that high dividends are paid out, because that is reducing here the value of the company, the substance of the company. Shareholder versus employees. Diversified shareholder can tolerate here firm-specific risk. Employees have an undiversified investment in a single employer. They are dependent on the performance of the employer. Whereas the shareholder themselves, the owner, they don't have just one horse in the race. They might have several companies. Whereas an employee, mostly is just working with one company. Management versus shareholders. Managers may be more risk adverse because of job security. Whereas here the shareholders, they want to have here higher risks. So, critical evaluation. What's the strength? Provides comprehensive view. Justifies risk management as protecting border interests. Highlights the need for governance mechanism. Critical limitations. Provides no clear guidance. What shall be prioritized? And we have stakeholder boundaries. They are often unclear. Interest diverse within groups, and may create decision paralysis. That means they cannot decide, because they are indifferent. They don't know what is the best decision, and therefore decisions might be postponed because several interests cannot be satisfied. So then let's have a look into question 19. Using global financial crisis as a case study, analyze how shareholders' behavior, limited liability, and diversification contributed to excessive risk-taking in financial institutions. What lessons can be drawn from the risk management governance? The context we know so far. How shareholder behavior contributed here. They had an extremely short-term focus. They were always focused on the return and to get their bonus. That's here. So they didn't even look into an risk. Asymmetric incentives. Shareholders captured the upside from the risky strategies, and downside potential was socialized here. And that's a typical approach. Profits, they are privatized. Losses, they are socialized. And that's a bit going in the wrong direction. Shareholder-oriented governance. Banks focus on shareholder interests rather than here stakeholder-oriented approach. Executive compensation, CEO incentives aligned here with shareholders. They encouraged even here excessive risk-taking. How limited liability contributed? Because the downside was kept for the owners, so they didn't care. The risk was shift The risk shifted to creditors, to depositors, and to taxpayers. There was also a moral hazard. Once an equity invested, shareholder benefits from the increasing risk. Historical evidence, Great Depression in the 1930s, that should have already been a lessons learned. But obviously, humans, they cannot really take a lessons learned in the long run. It's about the nature of human in being greedy. Greediness ultimately led to such financial crisis. How to diversify here? How diversification contributed to systematic risk? Because they sold already risky papers throughout the whole world, to sum it up in one sentence. What is the lessons learned for management governance? The capital requirements must be higher. That was then this Basel III regulation. Executive compensation reform. There must be deferred compensation, clawbacks. So in case they cannot reach the target, then they have to pay back. That linked pay. To align here with long-term stability. Also systematic risk oversight, macro-prudential regulation to monitor system-wide risks, not just individual institutions. Then the stakeholder governance, consider here also creditor, depositors, and so on, and not just shareholders. Resolution framework, mechanism here to allow bank failure without here systematic contention to taxholder bailouts. Furthermore, we have another 10 minutes to go. 10 minutes for 5 questions. If we are fast, we can make it. So, evaluate the role of market failures, asymmetric information and public goods problems in justifying risk management regulation. Provide practical examples of how these market failures manifest in organizational contexts. Asymmetric information that we already discussed. One party has more or better information than another, creates imbalance, leads to opportunistic behavior. Examples: product safety. Justifies here regulation. Public goods. That's here are product services enjoyed not exclusively by the non-exclusively by society. Examples: environment, global financial stability. Practical examples, that's the subprime mortgage crisis, product safety, pollution, employment. Also, if the employer is not disclosing the workplace hazards, for example, in a chemical industry, that the employers don't even know with which chemicals they are exposed to, then this would be here such an asymmetry. So 21. Compare and contrast here ISO with COSO. That's here direct here. You can here mention ISO. What are the key features of ISO? Where it comes from? What is the scope? What is the structure? The structure ISO is 3 elements: principles, framework, and process. So it's process driven. The focus is risk management integration into strategy, planning, and decision making. Key emphasis: shorter, more concise top management leadership. When you think about what is the scope of ERM, focus on financial reporting, now enterprise-wide strategy. 5 integrated components with 20 supporting principles. Focus on corporate governance, internal control, and audit of risk management. Both aim to integrate risk management into organizational objective. Both embed risk into decision-making. Both emphasize here continuous improvement and monitoring. Both are industry agnostic and can be customized. So what are the key differences? ISO uses formal internal standard process. COSO developed consulting partnership. Audience: ISO broader, COSO more accounting audited focused. Flexibility: ISO more adaptable, COSO more structured with free defined components. That's really very brief and concise here. What is the differentiation between ISO and COSO? Yeah, you can do it in exam like this, that you have here a table. Yeah, you say what is the aspect. Yeah, you look where does it come from, when it was first published, what is the primary focus, what is the target audience, what is the structure, what is the flexibility, what is the risk appetite, yeah, and what is the key strength. Yeah, and then you just come up with such a table, with these passwords, and you explain. Then you get the full marks in every respect. Yeah, you see here. Here's also the components mapping. Yeah, so which element is covered by which component in ERM. Yeah. Yeah, then let's look into question 22. 22 is about discuss the role and the role of the board and senior management in balancing the conflicting risk preferences of different shareholder groups. How do company secretaries and governance professionals support this process? Yeah, board and senior management responsibilities, they are responsible for setting the overall risk appetite. They make difficult decisions and to balance here conflicting stakeholder interests. They determine the strategy, which shall, of course, be balanced between risk and return. They ensure here the objectives are achieved. So it's about delivery, it's about execution, not just planning. They weigh up here the priorities, cost and benefit of different risk management decisions. They decide here also the investment level in risk management activities. So shareholder conflicts to manage, shareholders seeking higher returns versus creditors wanting security, just to highlight here one conflict. The role of the company secretary and governance professional, that's here is in particular ensuring here legal, regulatory, and ethical concerns are considered, supporting board decision-making with governance advice. They shall here facilitate effective communication between the stakeholders. They shall maintain compliance within the risk management regulation. They shall advise on best practice and international standards. They work together here with specific risk management staff when or where they are present. Yeah, finally, or no, not almost finally, question 23. Here we have a short scenario. TechStart is a digital technology startup that is seeking investment from a venture capital firm. The company's business model involves high-risk product development with potentially very high returns. Explain why venture capital investors might be willing to invest in such a high-risk company. Discuss how TechStart's risk profile might create conflicts, and what role should risk management play in the governance framework. So why invest? Yeah, asymmetric return, limited liability, portfolio diversification, risk premium. To invest in a startup that shall come with a huge risk premium, the so-called business angels, they often get returns far beyond 100%. Risk neutral behavior and industry opportunity. New market, disruptive potential. Digital technology offers here disruptive potential to open up a general new market, which didn't even exist before. Shareholder conflicts, shareholders versus employees. The venture capitalists, they want aggressive growth. Employees want job securities. Founders versus the venture capitalists. Founders may have a personal attachment, whereas the venture capitalists, they purely focus here on returns. The role of the management: identify and assess the key risks, define here the risk appetite, protect against the bankruptcy, balance the shareholder interests, and ensure also the compliance and build credibility with your investors. 2 minutes to go. Yeah, let's have a look. 24 is also a small case study. It's a chem process PLC. Yeah, here it's about identify the international regulatory bodies and frameworks that would most likely apply to this operation. Explain why environmental risk tends to be international in nature, and discuss how risk-based regulation might affect. Yeah, you see here, there is the International Labour Organization, environmental treaties, EU directives, ISO standards. Yeah, there is also a specific standards on environmental management. That's the 14001, and we have also ISO 45001, occupational health and safety. We have also chemical specific regulations such as REACH, GHS, global chemical labeling. Yeah, we have the G20 OECD principles of corporate governance. That's here. Why environmental regulation is international? Yeah, because environmental is not limited or is not bound to borders. Yeah, just here very briefly. Risk-based regulation, higher risk, so therefore a stricter regulation for chemical processing is needed. Greater volume of regulatory intervention is needed. More severe penalties for non-compliance in hazardous industries is recommended. More detailed compliance requirements and documentation also required. Higher compliance cost, of course, but appropriate to actual risks. Service sector compliant companies face lighter touch regulations. Yeah, that you have here this as well. Yeah, and then we can use the final minute here to finish off with another short case study, which is Global Bank International. They have the operations throughout the world. Yeah, explain the relevance of the Basel Accords, discuss how Global Bank uses ISO and COSO, identify key international agencies, and discuss how they shall balance here the needs of risk-averse stakeholders. You see here just big bullet points to each sub-question. Primary source of regulation. Now the third iteration, focus on international banks, minimum capital requirements, liquidity requirements, then risk weight, asset calculations, aim to prevent crisis and provide buffer against losses. They can use, of course, both systems. For ISO for strategic integration, COSO for our audit and control. To keep it short. Key international agencies, the Bank of International Settlements, they host the Basel Committee on Banking Supervision. They develop the Basel Accords. Financial Stability Board coordinates the financial regulation globally. We have also the International Monetary Funds. They monitor also the stability. World Bank, they develop finance and stability support. And we have also the OECD. And balancing the stakeholder needs, that's accordingly. This would bring me then to the end of today's session. And you see here, the questions are also visualized here in a way. You have also this dashboard, which would help you ultimately to gain a very fast insight. You see here, each question comes here with a short table overview. And really the essence, which shall be reflected by an answer if such a similar question comes up in exam. So thank you very much for your audience, and see you next time. And if you want, of course, you have also the opportunity to embark for our case study bootcamp, where we are discussing 16 case studies, in very, very meticulous detail, reflecting or covering all the entire syllabus. If you attend this boot camp as well, with these two boot camps, I think you can make it easily in exam and pass here with high scores. So all the best. See you next time. Thank you so much. Have a great time. Bye-bye. Thank you.